Okay, let's dive into a really fascinating piece of source material today. The 2020 shareholder letter from Goldman Sachs. It's penned by the chairman and CEO, David M. Sullivan.
Right, in 2020, what a year. This letter gives us a direct look at how a major firm like Goldman navigated, well, unprecedented turbulence.
Exactly. It wasn't just tough globally, it was a massive test for institutions,
Yeah.
and this letter is their perspective, straight from the top.
And just to help visualize who was leading the charge, we also have images of the key people mentioned. David Solomon, of course, Stephen M. Scher, the CFO at the time, and Johnny Waldron, president and COO.
Yeah.
It kind of helps put faces to the strategy.
Absolutely. So what was the scene they were describing? The letter really paints a picture of 2020.
It does. A global health crisis hitting millions personally. They call it a stark and complex environment.
Stark and complex, that captures it. You have this profound human suffering on one side.
And on the other, just incredibly high market activity, a real duality.
Yeah. And the letter tackles that head on, doesn't it? It acknowledges the swift action from central banks, governments.
The stimulus, pumping money in to keep things afloat.
But it makes it really clear that no amount of monetary or fiscal support could actually make up for the human toll.
Right. The lives lost, lives completely upended by COVID. That comes across strongly.
It does. It grounds the whole thing. But then looking towards the end of the year, the tone shifts a bit, right? Towards maybe cautious optimism.
Yeah, cautious is the word. Driven by the vaccine progress, the approvals, distribution starting up.
Even while keeping an eye on new variants, obviously.
Of course. But they note the global economy had already recovered considerably from the spring lows.
Giving them a sense, as they put it, that life after the pandemic was coming into view.
Which is, crucial context for everything else they report in the letter, especially performance.
So how do they actually navigate all this? The letter makes a case for the firm's adaptability. Remarkable speed, they call it.
Which, for a 152-year-old firm, is saying something. Rapid change isn't always in the DNA of institutions that old.
True. And they attribute that speed, that flexibility directly to their people, their creativity and resilience.
And the result, well, according to the letter, strong financial performance.
Delivered during, as they say, a tumultuous and at times deeply trying year.
And importantly, not just financials in isolation. They stress it happened alongside major efforts to support COVID relief in communities.
That combination seems central. It points to this theme of staying the course. They emphasize not losing sight of their purpose, advancing sustainable economic growth, financial opportunity.
And leaning on their core values, partnership, client service, integrity, excellence.
Yeah.
Especially when clients needed them most.
So it's framed less as inventing something totally new and more like holding firm to their principles enabled the adaptation.
Exactly, like an acceleration of what was already there rather than a U-turn.
Okay, before we get deeper into the strategy and the numbers, the letter does address something significant from their past, the 1MDB matter.
Ah, yes, One Malaysia Development Berhad. They note the resolution, and you definitely get the sense they want to put it behind them.
But they also seem quite clear about the lessons learned from it.
Very clear. The main point they highlight is how the behavior of, well, a few individuals can seriously harm the firm's overall franchise.
The reputation, the trust.
Precisely. And they talk about collective responsibility, being responsible for each other's actions.
And recommitting to ensuring everyone operates with the highest level of integrity. It sounds like a reinforcement of standards.
They definitely frame that way. A hard lesson, but one they state they've learned.
Okay, so let's unpack this idea of putting people first. The letter calls it an old principle that proved absolutely critical in 2020.
It really seems foundational to how they describe their response. The prime example has to be the shift to remote work.
I mean, the scale of that.
Within weeks, 98% of nearly 40,000 employees globally working from home. Just think about the logistics, the tech, the security.
It's staggering. And they didn't just, send people home with laptops. They focused on support.
Right. The letter mentions specific things. 10 days of family leave, free telemedicine access.
Which must have been crucial for many.
Absolutely. And even virtual wellness classes, fitness, yoga, story time for kids, acknowledging the immense pressure people were under.
And what struck me was the mention of employees looking out for each other.
Yeah, those spontaneous virtual things, tea sessions, cooking classes, sing-alongs, it paints a picture of trying to maintain connection.
Pretty unique for, a big investment bank, but it highlights that human element they wanted to preserve.
And even with all that, they managed to run their summer intern program remotely.
Over 2,700 interns and 120 associates welcomed virtually. They framed that as vital for passing on the culture.
Which is a huge challenge remotely. How do you do that?
Well, communication from the top was part of it, it seems. Monthly virtual town halls.
And those Sunday night voice notes from the CEO. A very direct, personal touch point.
Trying to keep everyone informed, hearing directly from leadership.
The letter also mentions the CEO himself continuing to go into the office, particularly in those really tough early months, March, April.
Right. He framed that as showing leadership was present, steering the ship.
And this all leads into a really key point looking forward in the letter. Getting people back to the office safely.
They seem quite concerned about the long-term impact of remote work on their culture.
Very concerned.
Yeah.
Specifically things like apprenticeship, collaboration, that spontaneous innovation that happens when people are together.
And the development of junior staff, the informal learning, the networking, mentorship.
Yeah, stuff that's hard to replicate over Zoom. So bringing people back safely is clearly stated as a major priority, rebuilding that dynamic.
That's a tension so many organizations are still dealing with. Okay, let's shift from the internal focus to how they serve clients during this time. The letter emphasizes consistency.
Unwavering support, they say, even amidst, well, literal disruptions. The example of the earthquake hitting their Salt Lake City operations.
And colleagues in Bengaluru, India, just stepping in seamlessly. That's pretty impressive coordination.
It really is. And despite everyone being remote, battling Zoom fatigue.
We all know that feeling.
Right. They state they maintain their high-touch, one-on-one client work, not letting the distance break the model.
And it wasn't just talk, it was tangible help, too.
Exactly. Providing essential liquidity through global markets. That's critical in a crisis.
And for consumers using Marcus or the Apple Card.
Assistance like skipping payments without interest piling up. Real relief for individuals.
Plus those interest-free loans for small businesses in New York partnering up to deliver that.
Up to $75,000. A significant lifeline for many small businesses, especially in hard-hit areas.
And beyond clients, they put significant resources into communities hit by COVID.
Yes, the contributions were pretty substantial, donating millions of surgical masks, N95s.
Critical PPE when it was desperately scarce.
Definitely. And developing that COVID-19 data dashboard for the UK's NHS using their analytical skills for public health.
And that partnership with Northwell hospitals and restaurants. Providing food, hydration for frontline workers.
Yeah, the letter even mentions the CEO personally getting involved, making sandwiches. A very direct, hands-on way to show support.
But what really stands out is how they targeted some of that support.
You mean the PPP loans?
Yeah, gained $775 million, but specifically channeling it through CDFI's Community Development Financial Institutions.
Right. Those are institutions focused on underserved communities. It was a deliberate strategy.
To get funds to small businesses, specifically in communities of color.
And the result they reported. Nearly half of the round one PPP loans they funded through that channel went to those communities.
That's a concrete metric showing a focus on inclusive impact, not just broad support.
And that ties directly back to their wider sustainable finance commitment, which covers both climate and inclusive growth.
Okay, let's switch gears slightly. The letter obviously covers financial performance and strategic progress. How did they frame doing well financially in such a chaotic year?
Well, they argue it wasn't accidental. They link it directly back to the strategic plan they laid out at their first investor day in January 2020.
Just before the pandemic really hit globally, talk about timing.
Right. They feel that plan gave them the focus, the framework they needed to navigate the storm.
And the numbers they reported were pretty strong. Net revenues up 22% to $44.6 billion.
Highest in 11 years, the letter states.
Diluted EPS earnings per share, $24.74, second highest ever.
And key profitability metrics.
Yeah.
ROE at 11.1%, ROTCE at 11.8%. Solid numbers.
Though it's crucial to mention, as they do, the impact of the litigation provisions.
Yes, the 1MDB-related provisions, $3.42 billion. That knocked down the reported EPS by $9.51 and the ROE by nearly 4 percentage points.
So the underlying performance before that hit was actually even stronger.
Considerably stronger, yes. And despite market swings, they say they gained share in their capital markets businesses.
Let's quickly run through the divisions. Investment banking.
Revenues up 24% to $9.4 billion. They kept their number one spot in M&A and equity offerings, top 4 in debt.
And they highlighted adding new clients through expansion efforts.
Yeah, around 300 new clients, generating over $800 million in revenue. showing that growth push was bearing fruit even in 2020.
Global markets trading, FICC, and equities?
Strongest revenue in a decade, $21.2 billion. Ranked #2 in both FICC and equities, improved returns.
And they mentioned deeper relationships with top clients.
Right, top 3, with 64 out of the 100 biggest institutional clients, up from 51. That suggests deeper penetration.
Okay, asset management.
$8 billion in revenue, record management fees, and this division really drove assets under supervision up.
By how much?
$286 billion increase, hitting an all-time high of $2.15 trillion firm-wide. Huge numbers.
And consumer and wealth management.
Also record year, $6 billion in revenue. Wealth management grew 10%. Consumer banking revenue is significantly higher. Total client assets there topped $1 trillion.
Wow. So broadly, they felt they were making good progress on the targets set before the pandemic.
Yes, despite the challenging year. They acknowledged the litigation expense hit the reported ROE and efficiency ratio relative to targets, but felt the underlying progress was strong.
And a big part of that strategy is diversifying, right? Building new businesses.
Absolutely. The letter details progress on 4 key initiatives designed for more durable revenue, better capital use, and improved funding.
Okay, first, transaction banking.
Launched mid-2020, saw really fast growth, hit nearly $30 billion in deposits by year-end, over half their 5-year target already.
And partnerships were key there, like with Stripe.
Exactly. Embedding their banking solutions into other platforms. It's about building those core operating relationships with businesses.
Second, third-party alternatives. Managing outside money and alternatives.
They raised about $40 billion towards a $150 billion 5-year goal, growing their institutional client list. And they sold off some of their own legacy investments, too.
To free up capital, right?
Yeah, expecting about $2 billion capital reduction from selling over $4 billion in equity investments, optimizing their own balance sheet.
Third initiative, high net worth wealth management.
Focused on wealthier clients. Added over 100 advisors despite the hiring slowdown. Expanded through acquisitions like Personal Financial Management and ICO.
ICO does corporate financial planning.
Right. Added 33 new corporate clients there. And they really emphasize internal synergies, referrals between divisions.
Generating significant potential new assets.
Over $7 billion in potential assets identified from over 4,000 referrals, connecting the dots internally.
And fourth, digital consumer banking, Marcus.
Huge deposit growth there, up $37 billion to $97 billion total. Hit their millionth Marcus deposit customer.
And lots of partnerships. Amazon, Walmart, JetBlue.
Yeah, embedding Marcus into other ecosystems, plus that second co-branded card with GM.
And looking ahead, they mentioned plans for digital checking accounts in the U.S. and Marcus Invest.
Correct. Expanding the offering, moving towards the mass affluent market, not just savers or ultra-high net worth, broadening the reach.
Okay, another strategic pillar was operating more efficiently.
They had a target. $1.3 billion in annual run rate savings over the medium term.
And they report hitting about half of that in 2020 alone.
Roughly half, yeah. Which was important, they say, to offset investments in growth and people.
What drove those savings?
Key things were automation, platform consolidation leading to more straight-through processing, lower cost per trade, getting leaner technologically.
And structural changes, too.
Yes. Realignments, optimizing locations, their location strategy, and reshaping the employee pyramid. And the shift to remote work actually accelerated their thinking on location.
How so?
Made them evaluate expanding into potentially lower-cost strategic locations more seriously, while maybe consolidating some existing, more expensive footprints.
Makes sense. We touched on sustainable finance earlier, but the letter gives it dedicated space. They argue the crisis really amplified its importance.
It did. They reiterate that huge commitment from late 2019, $750 billion over 10 years for climate transition and inclusive growth finance.
And they made progress in 2020.
Reported over $150 billion in sustainable finance activity just in 2020. Over $90 billion of that specifically towards climate transition.
So integrating it across the business.
Yes, setting up councils, integrating it. And they issued their first sustainability bond early in 2021, linking their own funding to these goals.
And on climate specifically, actions.
Advocating for the U.S. rejoining the Paris Agreement, committing their own financing activities to align with net zero by 2050. That's a big commitment.
And pushing for better data and disclosure.
Yeah, involved in things like OS Climate for data standards, setting near-term goals under frameworks like the UN Principles for Responsible Banking, integrating climate risk. They were preparing their second TCFD report, too.
TCFD is the Task Force on Climate-Related Financial Disclosures.
Exactly. It's about standardizing how companies report climate risks and opportunities.
Okay. Another area the letter strongly emphasizes is diversity and inclusion, not just as a nice to have.
No, they frame it as vital to the business, the strategy, financial performance, and they report tangible progress.
Like in talent acquisition.
Yeah, highlighting their 2020 America's Campus Analyst class, giving specific percentages. 55% women, 11% black, 17% Hispanic Latinx, 31% Asian. Historically diverse, they say. Global class, also over 50% women.
And they set longer-term goals, too, for retention and development.
Yes, specific 2025 targets for black and Hispanic Latinx vice presidents in the Americas UK and for women VPs globally. Mentioned their latest partner and MD classes were the most diverse ever.
They're also trying to influence the market.
Right, that policy for IPO underwriting, requiring at least one diverse board member for companies going public in the U.S. and Western Europe.
And planning to raise that to 2 diverse members.
Yes, planned for July 2021. Using their position in capital markets to push for change in corporate governance.
And on racial equity, specifically reacting to 2020's events.
Public statements against discrimination, allyship training internally, reverse mentoring from black leaders, and creating that $10 million fund for racial equity.
Supporting organizations fighting injustice.
Exactly, which leads nicely into their flagship community initiatives.
2 big ones highlighted.
First, 1 million black women. Launched just after the letter, March 2021, but clearly a major outcome of this period.
$10 billion over 10 years, that's a huge number.
Massive. Focused specifically on narrowing opportunity gaps for black women, healthcare, education, business capital. They emphasize the scale, calling it unprecedented for this focus.
And the second flagship program.
Their long-running 10,000 Small Businesses program. They surpassed the initial goal of helping 10,000 owners.
Because they committed more?
Another $250 million to serve another 10,000 businesses. Doubling down on what works.
And they added something new for the alumni.
Yes, 10,000 Small Businesses Voices. Helping the program graduates become advocates for policy change, giving them tools and training, empowering them to speak up.
So, after laying all this out, the challenges, the response, the strategy, the initiatives, how does the letter wrap up? What's the outlook?
Cautious optimism, again, for 2021. Contingent on, the virus, vaccine, stimulus impact, geopolitical risks, the usual suspects.
But internally, the focus remains.
Helping more clients, building those durable revenue streams through the new initiatives, staying the strategic course.
And the CEO's final message.
Pride in the 2020 progress, but also humility. Strong belief in the strategic plan, the leadership, the culture, and crucially the people, to deliver better, more sustainable returns going forward.
It really paints a picture of a firm under immense pressure, arguing that its core principles, its strategy, and its people allowed it not just to cope, but actually to accelerate change and strengthen its position.
That's definitely the narrative presented in the letter.
Right.
Resilience in strategic execution amidst crisis.
So wrapping up this deep dive into the Goldman Sachs 2020 shareholder letter, you really get a direct insight into how a major player saw and navigated that extraordinary year.
Balancing that stark contrast, the global hardship versus the market activity.
And hearing their argument that putting people first, employees, clients, communities, was fundamental.
Fundamental to adapting, executing their strategy, and even deepening commitments to things like sustainable finance and diversity, right in the middle of it all.
It certainly makes you think, doesn't it? How a year of such intense global disruption like 2020 serves not just as a challenge, but maybe as a powerful catalyst.
Yeah, an accelerator for trends already in motion, and maybe more profoundly, a real test of core principles revealing what truly matters for big institutions and maybe for all of us.